All right, in today's video, we are going to look at an individual interested in a whole life insurance policy for the cash value. They're interested in funding their policy with $10,000 per year until they retire. They've got a target retirement date of 60 years old. Now they're interested in saving money for retirement, but a big reason why they're interested in whole life insurance is because they also want to be able to use the money during their working years. That's a nice feature about a whole life insurance policy with respect to the cash value and how you can access it. And when you do, it continues to earn interest as if you never touched it in the first place. We'll look at a specific example of that. So what we'll look at here, firstly, the reasons why she is interested in a whole life insurance policy for the cash value benefit. Number one, the guaranteed growth. She's got guarantees associated with it. When we look at the illustrations, they will be based on the insurance company's present dividend interest rate. However, she likes the guarantees and really the fact that the cash value in a whole life insurance policy does nothing but just gradually increase over time. The tax benefits are also very appealing to her. If you do everything right, you can access the cash value tax-free. That can be during your working years while you are using it for opportunities. It can also be during retirement. A lot of people will put money into whole life insurance products with a specific goal of drawing down that cash value in retirement because they can do so tax-free. We need to make sure we don't mess it up and trigger a taxable event, but that's very easy to do. And that's mainly on the agent's side to make sure that they do everything correct. But she's interested in the tax benefit piece. And then we mentioned this, she's also interested in accessing the cash value for opportunities. Really, she'd prefer not to have to deal with a bank. She just wants to be able to access her money quickly and use the policy a lot like her own bank or a personal line of credit. We will look at that in this video. So some questions she had first. With the policy regarding putting money in, what happens if I lose my job? Can I reduce the dollar amount that I'm paying into the policy? Because I'm 30 years old right now. My plan is to fund $10K per year. I don't think I'll have a hard time doing that at all. However, what if life happens or I just want to allocate my money somewhere else? Can I reduce the dollar amount, specifically that $10,000? Or can I stop altogether? Meaning, can I stop putting money in without cashing out or canceling the policy? Does the policy lapse if I stop paying it earlier than originally planned? We'll look at an example before I just answer the question. Sometimes I do that. And then we'll also look at using the policy for an opportunity. We mentioned that the policy works a lot like a line of credit. So what you'll see when we look at the numbers is if you've got cash value of $100,000, let's pretend that it's earning a net return of 5% annually. So if you just let it sit and grow, it's going to compound by 5% every single year. If you elect to take a policy loan, meaning if you borrow against your cash value, let's say you take $50,000, we'll assume that the cost to borrow in this example is 5%. What happens? Well, you pay 5% to the insurance company. You have remaining cash value, we can call that remaining equity of $50,000, earning how much? 5%. That 5%, as far as what you're getting with a life insurance policy, actually still on the full $100,000. So even when you take a loan against the policy, you'll continue to earn interest on the full cash value, not just the remaining equity, which is a really nice feature about it. Let's take a look at the different models. What we'll look at first is just maximizing the cash value growth. We're going to look at exactly what she requested, $10K per year until she retires. Her target date is 60 years old. So that's funding a policy for how long? She's 30 now. She's halfway to 60. It's another 30 years. That's how much total going into the policy? $300,000. This is a nice starting point because this demonstrates just a fixed savings plan, meaning here's how much I want to save every year and set it and forget it. If I want to access the cash value, I will, but show me what it looks like over time. So let's take a look at the numbers, shall we? So we'll begin with a full illustration. One page from a full illustration, you'll see we've We've got page 19 of 27. But here's the important part. Here's the funding, $10K per year, and it does go until year 30. We'll scroll down in a moment. But what I really want to start with, this is where I always like to start. If this is me, here would be my question. Where is my money going? Because with a whole life insurance policy, when cash value is the goal, where people have buyer's remorse, they say, oh man, I wish I would have known that beforehand, rarely has to do with policy loans, accessing the cash value, nothing like that. It always has to do with the design of the policy because one feels like they did not ask enough questions in the beginning, they weren't shown enough options, and really they just wanted the cash value maximized. So, where's the money going? In this illustration, you can see it up here under this column, annually. Here's your premium, $1,100 and change. Okay, so that's your underlying base premium, which is just about your minimum commitment. We do have a small term rider expense as well. So the true minimum, if we were to look at the numbers, would be around $1,200 per year or so. So it's about $100 per month if we were to break it up over 12 months. But when we look at this policy, we've got the premium, then we've got different riders and terms, which we've got term insurance, and then PUA riders. Point is, we've got a minimum premium close to 10% here, and then we're stuffing money into our PUA rider. That's how we maximize the cash value. When you look at a lot of the major mutual companies, we can get the minimum base premium usually down to close to 10%, sometimes a little bit lower depending on the company. But really what I want to know is what are the limits offered by the life insurance company and how low can I go on the base premium? All right, so this has a minimum base premium. When I look at the cash value, the first year, I've got 92%. When I look at the break-even point, by the fifth year, I've paid $10,000 per year, times 5 years is $50,000. And I have 50, almost 51. I'm really breaking even between years 4 and 5 when I look at it. Year 4, you're oh so close when you look at the cash value. You paid in 40, you've got $39,000 and change. So we fund this illustration for 30 years. After year 30, our outlay is 0. What we're going to look at is this illustration with this exact design, and we'll answer the 3 different questions, which were, well, 2 different questions that follow up with his first question. What happens if I lose my job? Can I reduce the dollar amount? And can I stop early without cashing the policy out? Let's take a look. So what we've got first is the illustration we just looked at, but just a simplified version of it. So we see the 10K per year. Your break-even point is highlighted in yellow between years 4 and 5. Okay, perfect. What you'll also notice here is your death benefit gradually increases over time. When the cash value of a policy is increasing, the death benefit will increase with it as well. Sometimes you'll see that we have a level death benefit. The reason why is because we have a 1-year term rider. Kind of works like a seesaw, where if I have a whole life policy and a term rider attached, I might have a total death benefit of $1 million. My whole life policy starts out at $100K, my term $900K, and as my whole life goes up, my term comes down, keeping me level at the same $1 million. You'll see that in many of our videos, not in this one though, in case you're looking at different companies and products. So there's the 30-year funding sample. Let's take a look at what happens if I reduce my funding, or can I reduce the dollar amount? The answer is yes. And we can actually kick the minimum down close to that $1,100 premium figure we mentioned. If we want to cover the cost of the term, it'd be about $1,200. But here's what we're doing. Funding $10K per year for 5. We'll assume that this was the plan over on the left, but this actually happened. I need to make a reduction in year 6, and then I just keep it reduced. And I say, you know what? I'll just keep funding this until my retirement date. If I've got an extra $8,500, I'd put it somewhere else. It's up to her at the end of the day. We'll always go over the pros and cons of putting it in the product, but it is up to her or you if you're the one considering a policy. So because we funded it the same for the first 5 years, you'll notice that the funding for the first 5 years is identical. The difference is when I hit year 6, I will see less in cash value here. And the reason why is because you've paid less money into the policy. $1,500 per year instead of $10,000 per year. And then we see the difference at age 60 as well. And then to hit on our question, what happens if I stop? There we go. Same thing, where she gets a total of $50,000 in the policy. And after that, pays nothing at all. Did you know that you could do that? This is a really popular strategy, by the way. A lot of times what we'll see is someone that says, hey, I'm interested in a whole life insurance policy for the cash value benefits. The death benefit's valuable to me as well. But I'm not into the idea of having to make premium payments for a long time. Can I just take a lump sum of money and get it into a policy quickly and then be done with it? Is that possible? The answer is yes, it is. So in a case like this, we might see someone the same age say, hey, I've got some excess cash over here that I'd like to get into a whole life insurance policy. Can I do something like this? Or does this make the most sense? The answer is yes. It does make sense. Does it make the most sense? If it's for a 30-year-old female, I'd probably break that up over 2 to 3 years, that $50K lump sum. But my point is, funding a policy in this manner, it could happen if this was your original plan and then you decided to stop early, or maybe life happened and you had to stop early. It demonstrates the fact that you can stop and the policy does not lapse. You do see a move we made here where we reduced the death benefit, but again, we stopped. You might also come into it planning to do this, but what we'll do is design the policy the same. So if you plan to fund it for 5 years and say, hey, can I still add money? Is that possible? The answer is yes, you can. So we've got the different growth models here. What else did we talk about initially? That she was interested in doing what? Just putting money in there and saving for retirement? Using it for opportunities. So let's take a look at actual policy loans. We'll look at our loan workbook, which is something that we use quite a bit with individuals that work with a company. So here we go. Here we've got the growth illustration on the left. This is the 30-year fund. This is her plan. We can drop any of the illustrations in here. Here, LTV at 95% of cash value. This represents the maximum loan that we can take. And right now, the variable loan interest rate with the insurance company she selected or is gravitating toward is just under 5.8% if she starts a policy this month, December of 2023. So here's what I like to look at with this loan workbook. What's the cost to borrow versus the yearly cash value growth? Meaning, what am I getting from the insurance company and what am I paying them? So let's assume she wants to have some fun and buy a new car 6 years into the policy. Costs her $50,000. She does not want to deal with a dealership and financing it. She says, I've got the cash. I just want to buy it outright. Okay. She borrows against her policy. What you'll notice, look at your LTV column. Let me get rid of the loan, $59,000 and change. Let me put the loan back. The LTV column dropped. This represents the maximum loan you can take. It's 95% of your cash value minus any outstanding loans. Okay. 5.8%. Over here, columns S and T. This is going to show you year over year what your policy is growing by, yearly cash value growth, and what you are paying in loan interest, annual interest payment. This workbook does assume that you pay the loan interest annually. So here, $2,900 per year, paid every year. We're assuming the loan interest rate never changes. It's a variable rate with Mass Mutual, so it's going to change, most likely. But in this example, what do we notice? Well, for the first 3 years, assuming she pays nothing toward the principal, what she pays in interest exceeds the net growth or the net dollar amount the policy is growing by. Finally, down here, which is year 9, the annual gains exceed the annual interest payment. This assumes she's paying interest only. Let's assume that in addition to the interest, she throws another $5K at the principal. One too many. There we go. So if you pay down the principal, what's going to happen is you're going to pay less in interest every year. So there's your principal payments. Here's your interest payments. And then here's what you're still funding the policy with. So her out of pocket is what? 10K plus 5K is $15,000 plus an average of 2K, that's $17,000. If she says, hey, that's a bit too high for me right now, one of the reasons I went with the policy was to have more control over my payments. If I went with a car dealer and financed through a bank, I would have to make those payments, but that just usually puts a lot of stress on me. I lose sleep at night. Like, I don't want to go that route. So can I reduce the payment here and pay it down over a longer period of time? Or during some years, can I pay more? The answer is yes, you can do that. So let's say she did something like this and started out at $300 a month toward the principal. You know what? Let's just make it $3,000. She does that. Then we'll assume 1 year she comes into a windfall, throws 10 grand at the principal, then back to 3. You can pay it back however you'd like, which is nice. And with different payment schedules, you see different amounts going toward the interest. So you can compare it year over year and see, what am I getting compared to what am I paying? The next 2 columns are similar. I can see the total gain on cash value over time, which is simply how much more do I have in cash value than my total payments, and then the total interest amount I've paid over time. I like that column a lot because a lot of times we get the question from anyone is, hey, how much did I pay in total interest to the bank on my mortgage? Because I know the interest rate is 3% if I got it a while back, or whatever the interest rate is, but I pay a lot more in interest up front. I just want to know the total dollar amount I paid to the institution, in this case, the insurance company. So this just tallies everything up so I can see it. So that demonstrates how she can use the policy. I mean, when she's taking this $50K, she's using it for a car. If she's using it for real estate or something else, then we can look at taking the cash flows and applying them toward the loan principal to pay it down faster or something like that. But the purpose of this workbook is to help break down the numbers so I can see, what is my policy growing by compared to what am I paying in loan interest. So I hope you enjoyed this video. Let us know your thoughts, and if you have any questions at all, feel free to leave them in the comments below or reach out to us directly. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.